All right, guys, welcome to the fifth day of this training, right? So today is the day before the last day, and I'm so excited. So sorry for the delays on for this call because I'm kind of really engaged. Some guys actually believe that some of us the only thing we do is to trade, right? We don't have anything to do with our lives, right? So this was one of the instances where life happened, and sorry about that. Got involved with a lot of things that's really kept me late. I was thinking that I'll be done, and we were started having some issues, and that's why they call us delayed this long. So sorry about that if you were already waiting for us, and I hope this call will meet you well. All right. So welcome again. So we are talking about smart money concept, right? So some of you guys are always like to ask me, what strategy do you use? What strategy do you use? All right. So for the purpose of posterity sake, so I use smart money concepts. That is the strategy I use. My trading strategy is what smart money concepts. All right. So I'm talking about it as a strategy, right? All right. So the first things first, I want you guys to look at this picture. This is a picture of a cow and a bird. All right. So this will be the best definition of smart money for you guys to understand. All right. Now, in the financial markets, we have two kinds of traders. We have the people that have the money to move price, and we have those that um, cannot move price. All right. So the guys that can move price can be seen as this cow. They are big, they are heavy, and they have what? Mass and weight. All right. So they have this cow walks on a piece of land, you're going to see the hoof prints, right? No hoof. Yeah, I don't know what they call the leg of the cow, but you're going to see the marks of the leg of the cow, of the foot of the cow, because why? It walked through that piece of land. That is how smart money is. When smart money gets involved in the market, you will see their footprints. Why the bird are the retail traders? Now imagine that this bird is trying to fly against this cow. What is going to happen? It's likely going to break its neck and do what? Die. All right. The cow can move the bird, but the bird can't move the cow. Now, for this bird to actually survive, the best thing this bird can do is to perch on the back of the cow. So as the cow is moving, it's moving alongside of the cow, right? So that is how you should see smart money concept. Smart money concept strategy is a strategy that shows you the footprint of the bank, shows you what they are likely going to do, and then you follow what smart money is doing, right? So you want to be like that, but especially on smart money, being the big cow, right? Or the big bull or ox, right? So that's what it's all about. That is just a depiction of smart money strategy, right? So I won't be talking about all of them because of time. I cannot really talk about it, but there's so many of them. So for the purpose of this call, I'm talking about just basically two, right? And the rest, they're obviously in my paid mentorship group, and I've talked about some of them on my channel, like breaker blocks, mitigation blocks, all those stuff. They're all on my channel, right? So let me kind of list them out. So smart money strategy is not like an indicator. Like when you say when it crosses, you buy, when it crosses, you sell. No. Smart money concept is different in the sense that it involves you reading price. You have to learn how to read price to excel as a smart money trader. There's no indicator crosses. You have to what? Read price. You have to know what the market is doing. You have to look at the ground and tell where the cow is going and then move in line with it. So this is one thing that makes smart money concept different from every other strategy. Unlike support and resistance, just okay, just draw a line, so sell here, double top. No, but smart money, when it comes to smart money concepts, you have to read price. You have to anticipate. You have to build anticipatory skills to understand what the smart money entity it will likely do and how to do what maximize the trading by following them. All right. So now we have understood that. Now there are various smart money strategies of various concepts that make up smart money strategies. So we have things like the institutional candle, which I'll be dwelling on. We have the institutional candle. These are smart money concepts. We have what? The imbalance, or we can call it the fair value gap. Right? These are all smart money strategies you can use for your trading. We have the breaker. We have the mitigation block. These are all strategies under smart money. right? We have the mitigation block. We have, we have turtle soup. These are all smart money strategies, right? We have the turtle soup. We have what's the other one? There's one I'm trying to recall. Very, very beautiful one. Forgotten. Turtle soup. Yeah, if I remember it, I'll just type it in. We have other blocks. These are all smart money strategies, right? Other block, right? So all these strategies can stand alone and they can also depend on each other. For instance, an institutional candle can depend on an imbalance. An imbalance can depend on an institutional candle. A breaker can also move in line, like depend on an imbalance. Mitigation block can move with an imbalance. Turtle soup can move with an imbalance. Turtle soup can also move with another block, right? So they are just elements that make out what smart money strategy. So it's not like it's just one thing, right? So smart money does not refer to one thing, right? In smart money, you also refer to time and price. Right? I talk about that too. So it's also a smart money strategy. I talk about time and price. Very important, time and price. So those are all the things that make up smart money strategy. All these things listed here, right? All these things, and these things are a result of what smart money being involved in the market. You will see an institutional candle when smart money is involved. You see an imbalance when smart money is involved. A breaker, mitigation below. All these concepts are things that you will see when smart money is involved. They're the footprints of the cow, which you need to follow to understand what you want to do. All right. So by God's grace, I talked about time and price in the previous course. I've covered time and price. So for this particular call, I was talking about the institutional kind, right? I have a video on imbalance. You can just check my YouTube channel. I can't talk about imbalance because I want to go in depth on institutional candles. That's why I don't want to talk about imbalance. So watch my YouTube videos. I've talked about imbalance about 2 or 3 times. You can watch it and have fun. All right. So let's just talk about institutional candle. That is the most important one. So based on this, they have their degree of frequency, their potency, and all of that, right? And all depend on top-down analysis. So for me, I usually use these two a lot. I use institutional candles and imbalances a lot. These two, so the two I use most. Institutional candle and imbalance. Okay, I remember one now. Smart money cube. So we have the cube, right? We have the smart money cube. I didn't remember that early. So we have the smart money cube. All right. So those are the things that when you're talking about smart money, you're referring to all these things. All right. So for the sake of this call, we're talking about just one, which is what the institutional candle, right? So institutional candle. All right. So that's what I want to talk about. Now, I don't know if you guys have been in a trade where you had a kind of resistance level, or you're trying to sell, and the market took you out before doing what? Going down. Now some of you have seen all this thing happen all the time. As you have a support level or resistance level, and market does this, it takes you out and then what? Sell immediately, right? This whole move is also the effect of what? An institutional candle. Why is it institutional? Because the candle is printed by an institution, right? No single person has the money to move price, right? It's usually the work of an institution. When you see markets moving with such a right, like I was saying. Now, the institutional candle is printed by smart money buying against everyone else and then reversing price to the downside. Right? This is for an example of a bearish institutional candle, right? It's bearish in the sense that it's bought before doing what? Selling. All right. So the act of smart money buying to do what? Sell, right? They did this to do what? To take out what? Liquidity, right? So when if smart money bought here and then they now sold later on, all right? Let's assume that they bought at this price level, right? Let us just make this very easy, right? So they bought at this price level, right? And then they sold at this higher price level, right? So they sold at this higher price level. So I'll kind of change the color of that so as it to be different. So you guys can get what I'm talking about, right? So they bought at this black level and then they sold at the red. Now, when price gets down here, what happens? This buy position becomes what? In loss. Why they sell is in what? Profits. Note, they bought at the black line and then they sold at the red line. Why did they buy? So that they can do what? They can trip off your stops and then pair your buy orders, your sell orders with their buy orders. So they will buy to take your stop loss because you are selling here because of what? Resistance level. So as you're selling, they want to they want the others to be paired with their own. Why? Because the others are huge. So they want people to be able to take the opposite side of their trade. So what they do is, what do they do? They buy your sell positions and then sell at a higher position, and then you buy from them. Because if you sell and your stop loss get tagged, automatically the broker has bought for you. So if you sell a market and stop loss get tagged, you have bought. And if you bought and stop loss get tagged, you have sold, and you have sold that it was a bad price. So they are going to buy, trip you up, pay your buy orders to their sell, pay their buy orders to your sell order, and then what, reverse price. So now they can buy maybe here with maybe a one lot and then 500 lot above. So now when price comes down here, what happens? This buy is a loss. Why? Because price is what, below the buy. Why they sell a red is in profit? Because it is a sell position. So what smart money does is that they have to do what? They have to move price back to where they bought and then close their buy positions. And this is what you want to be looking at for when it comes to institutional candle. You want to see price trade back to where smart money bought to take out stop loss, and then you want to be selling there because most times or most often than not, market will do this. It will continue selling off. So they're going to close their buy, add more sales, and don't forget they had a sell up here already. So they're going to buy, they're going to sell here, they're going to close their buy, sorry, add more sales, and then hold this one, right? And then same price lower. So they now have what, two sales and what, profit. So this is the whole idea of institutional candles, looking for where Max not only bought to take out stop loss and then reverse price breaking structure. So there are two things you want to see. You want to see what, a liquidity graph. Those are the things that make up an institutional candle. You want to see market take out stops, right? Take out stops and then what, break structure to the downside. Note, market must take out stops and then what, break to the downside. So you have to wait for price to come back there and then look out for what, your confirmations to do what, to take your sell positions, right? So other smart money concepts have been discussed in our paid mentorship group by God's Grace. I'll talk about every other thing here. So you can join us if you want to learn more about them, because for the sake of this call, I want to just introduce this thing. So some of other ones here, I've talked about them. Like this one now, I've talked about imbalance in my YouTube channel, breakout idea, Turtle Soup. I don't think I talked about Turtle Soup so much, but other blogs, time and price, they're all on my YouTube channel, right? Apart from Smart Money Cube. So most of this have been discussed very in deep details in our paid mentorship group. So if you want to like to join us, join us. And if you're already in the paid mentorship group, check the library group, the resources group. All these things have been discussed today. So don't come and ask like I've not said it. All right. So now this is for a bearish opportunity. Now for a bullish one, it's just the reverse. So the market is what is giving what a support level. It will go below it and then break to the upside. So now you have what that support level we are looking to buy. Price does what, violates it, and then what gives you what, that break of structure, and it's still the same thing, right? This is a break of structure. So smart money, what is smart money doing? Smart money was they sold somewhere around there, and then do what? They now what, bought what, below. So the buy will be the one in blue. I want you guys to get this. So the buy will be what, in blue. So this is the whole idea of what, smart money concept, right? For institutional candles. So you're looking at price to come back to where, you remember they sold here and then bought below. So this sell is in what, loss, because why? Price is what, above, right? If price above your sell order, what will happen here? Loss, right? So they have to bring price back down to mitigate their loss, and then they can now do what, close and then what, add more buys. So looking at those areas where smart money took out stop loss and then broke structure for what, your trade idea is very simple, nothing again. So I don't want this call to be so long. Let's also head over to chat because I've already wasted your time already. So let's head to straight chat and look for distance immediately. So you can see it very clear. That's the first one on GPAUD. Can you see that? So you have to now note, before you look at national candles, you have to trade the ones on the higher time frame. So I'm just giving you guys a pictorial example on the lower time frame, but when you're going to look for these things, you have to go to the higher time frame to spot the institutional candle, and then use a lower time frame to do what? To look for what? Your confirmation. So this is just a crude diagram. What do you have here? Market did what? Can I say market took out stops? Can you see what I'm talking about? Market took out stops, right? Did it take out stops? Yes. Did it break structure? Yes. You can see market broke structure. What happened? The price come back there? Yes. If you draw this in time, can you see how price has come back there. You can see how it's rejecting up to do what? To buy. So let's head over to a daily time frame to see it on the higher time frame. Let us go to the higher time frame where an additional candle played out, right? All right. So I want you guys to catch what I'm teaching you guys, right? I want you guys to follow. All right, look at a very clear example. So at this daily time frame now, what do we have here? We have what? A support level, right? Support, right? So resistance, right? What happened? The market was went above it and then was broke structure. Note, market has to take out stop loss and then was break structure, right? So now I have what? Your break of structure here. What do you now have? Now look at what? The candle that took out stop loss. And now note, an instrument candle is not necessarily the last candle, right? If you were selling here, you would not have gotten written on this. It's not always the last candle. It is the whole impulsive move. Like this is the instrument candle from here up to that point. Because that's where the whole impulsive buy started. But to make it easier, you can simply mark the 50% of the whole move. So you cannot simply bring out your gun box, take from the open to what? Open to what? The high. And then mark what? 50%. So you can see market just came exactly at 50% and what? It sold off. So those make it easier. You can also mark 50% from the open price to the high, right? Or to the close. But I like to use, you can use here your close. This is the close. Because the volatility of the candle is at the close and open prices, not the wicks. So you can simply mark from the open to the close of the institutional candle and then look for 50%. The wicks are not important, right? The close of the candle rests in the body, not the wicks. So you can simply just draw from here to here and take 50%. Or if you prefer, you can still draw to the highest point and then draw from what? The lower wick of the candle, right? It's still 50%. So I prefer body to body. So I'll be very sure that's what I'm getting. So now you can also highlight 50%. And what do you do? When you have marked the higher time frame, you look for what? A lower time frame confirmation. So market, if you have what? That is not candle. When price comes here, you're not going to sell on a daily time frame. What do? You come to a lower time frame and look for what? A confirmation. And a confirmation is what? A break of structure. So markets should come to the lower time frame and then what? Still do what? Give you another break. So this can be your 15 minutes chart. Why this is your daily. So inside here, inside this point of interest, you're not looking for what? Your break of structure on a lower time frame. You look out for a break of structure on a lower time frame, and that's what we had here. So it's quite far. I can't go for that far, right? Inside there, looking for what? Your lower what time frame. Look at another example here. What happened? Market did what? Broke this structure here. Consider this BS. What do you have? A BS. The price taker stop loss. Yes. Consider this market took out stop loss. This the customer market stored there. 1, 2. Some people that have bought there, market took them out and there was reversed up. So how was that break off? So markets came back there. What happened? Market did you buy? Yes. And if you draw this in time, so that was actually what was actually a lot of liquidity here. So market took out all this stop loss and it was broke upwards. What happened? Markets came back, retested those candles and it was he bought. And you can see how an imbalance lined up inside there. So there was an imbalance here. So imbalance kind of give you a precise area to look at for what your confirmation on what a higher time frame in instrument candle. So there's an imbalance entry there. So if you see this BS, you can if you're confused, you can simply use the imbalance to just streamline where to look out for your entry, right? Not the imbalance to streamline where to look for your entry. Like in this case here, if you use an imbalance here, it would have still been nice. So you see an imbalance entry there. So you can see market just came for that imbalance, just hit it and then it fell off the face of the earth, right? So this is how you can play instrument candles, right? So I've made more videos on this. They're all over my channel. You can watch my videos on institutional candles. They're very beautiful and all of that, right? So I think I've covered institutional candle. Let me just quickly talk about one last thing and then we'll wrap it up. So when it comes to ICT optimal trade entry, you're referring to what? Your Fibonacci levels. Fibonacci levels between what? 61.8 and what? I'll make a special video on this. I'm not giving you guys an introduction. So when it comes to optimal trade entry, look at fib level between what? 62 to what? 79. So that is your optimal trade entry. So if you're bullish, right, you want price to retrace to that level and then you get into your trade, right? I'll make a separate video on this as and post it maybe before tomorrow's call, right? So if maybe you're bullish, right? You're bullish, right? You want price to retrace to this area to give you what your buy. So I still optimal trade entry is just simply drawing your Fibonacci tool from your swing high to your swing low, and then marking what 62 to what 79. You can put your limits there, and stop loss should go was below what the one. But if it's on a lower time frame, if it's on a higher time frame, when price comes there, look out for what a lower time frame BOS. But if it's a lower time frame, you can simply put your limit at what is 2% and do what put your stop loss at the one. That is all. So you're not really doing anything when it comes to feedback. No, you're not looking for BOS. Where so if you're using ICT OTE for your entries, just simply mark from swing high to swing low if it's bullish, and then put your limit at what 62%. Stop loss was below one, and then you're in the trade, right? If it's on a lower time frame. But if it's in a higher time frame, we look out for what confirmation when price get to what this area 62 what to 79. So I'll make a separate video on this to explain this in detail. So I hope this call is insightful. Sorry for the delays. All right, so we'll talk more as we progress. Right, so tomorrow is going to be more of a trade psychology call. We're going to talk about more of psychology, risk management, and all of that. Right, so I hope you guys find this insightful. Go and watch my boot camp of 2023. So it's an assignment. Go to my 2023 bootcamp and watch my video on institutional candle. Talk about this in more detail. So watch my 2023 bootcamp, right? I talk about institutional candles there, right? I talk about the 30 videos. So I'll post the link to in the comments. So watch the video there. It explains institutional candles, more details, more examples. Just get the main takeaway. That price takes a liquidity and then breaks structure to give you what's your entry, right? So see you guys tomorrow, which is the final day of this meeting. So if you want to join our paid mentorship group, just do it to send me a DM and you can be part of us. All right. So see you guys when I see you guys.